Advanced Micro Devices Inc. AMD is currently trading at $108.56 a share. It has been absolutely hammered over this last year, down around about 40%. If we look at the 5-year chart, it was previously trading its all-time highs at around about $202 a share, and as said before, down around 50% since then. This has wiped out all of its gains from the back end of 2023 and the entire of 2024. What we're going to be doing is going through their most recent earnings, talking about why the stock has gone down, and then going to my automated stock valuation spreadsheet to see if AMD is a buy or a sell using the discounted free cash flow model, comparable company model, and the Ben Graham formula for intrinsic value. So firstly, I will just put the ticker in here, AMD, and this will load up all the latest company financial data so we can have a deeper dive. If you're interested, check out my Patreon. It is the $4 tier, but we'll talk about that more later. So this is just loading up here. If we do go back, well, actually, no, we'll go through here first. So $106 a share, market cap of around about 170 billion, PE ratio of 106, which is a lot higher than the market average, which is currently at 28.3. Earnings per share, $1. Beta of 1.74, meaning it's a lot more volatile than the market. Analysts, interestingly, still say it's a buy, $146 a share. So we have the revenues numbers here. Trailing 12 months and 2024 the same, but 26 billion on the full year. Now this is all-time revenues, as you can see here, that they increased massively after 2020, jumped up again, but have been relatively flat from those initial big jump ups. So if we do go back to the fourth quarter results, this is the fourth quarter and full year. Let me just scroll down to the revenue section. Very, very long. So this is the 3 months ended December the prior year, 23, the prior quarter, September 24, and then finally the current quarter, which is December 24, and we also have the full year here. So prior year 6.1 up to 6.8 and now 7.6, and we have the full year 22.6 billion, down slightly to 25.8. And if we scroll down once again, we have the segment category information here. This is split up into data center, client, gaming, embedded, and all other. Data center, this focuses on the CPUs, GPUs, the data centers, the cloud, computing, the AI workloads. Client is the CPUs for desktop and laptop computers. Gaming, CPUs and GPUs for gaming PCs and consoles. Embedded is the processors from very better systems, industrial, automotive, network, things like that. We have the, can I get this all on one screen? Let me just click down a smidge. There we go. So we have, once again, prior year's quarter, prior quarter, and the current quarter, and then we have the year ended as well. So as you can see here, their largest segment, which is the data center, this was where they had the biggest growth, from 2.2 to 8.8. I wish 3.8 billion, and you can see it's up as well. Client up, gaming down massively, 1.3 to half a billion. Embedded also down, and all other, we can see here operating losses. So overall it is up, but yeah, we can see here that the largest segment is the data and revenue, and this is the growing segment. This is why everything has been increasing, but obviously the stock price has not reflected that recently. So revenues are looking good, they are up, but have slowed. Profit, 1.64 billion, down from its all-time highs, but has increased over the last year. Free cash flow, they're generating good free cash flow, not all-time highs, but 2.4 billion. If you look at operating cash flow versus capex, you can see operating cash flow is increasing, but capex is also as well. They have spent a lot on capex. Shares outstanding, what are they doing? There'll be some splits in here as well, but they are issuing more shares and not buying back the shares. So let's have a look at the discounted free cash flow model, a way of valuing stocks to look at their future free cash flows and discount them to today's value. Let me just put in the average numbers here, and then we can have a look, although I think it'll be quite interesting with that higher number. Yes, currently hesitant to buy, but I don't like the look of that free cash flow rate. We'll have a look at this. But we're expecting revenues of 30 and 34 billion in the coming years. Let's see if that is close to what analysts are expecting. We're a little bit on the negative, 32 and 38. We'll see what the growth is as well, 33% in the next year. So what we'll do is we'll bring this up a little bit to about 18, no, we'll go 20%, puts it to 125, but we'll change the weighted average cost of capital to its current value. Okay, so that's a bit more closer, but that is quite high. We'll bring this down to the normal discount rate, about 8%. Net income margins, okay, let me undo that. We'll keep it at 8.5 for now. Net income margins, these have been decreasing. I think we'll take an average of these last few years, which is 6.3%. There you go, that brings it down massively to $63 a share. And finally, net income to free cash flow. These numbers are all over the place. We've got 24 to 80%. I mean, if we take the last year, which is 146, it is not a buy at 63. If we take the highest year, which I don't think that is a consistent number, you can see it's a massive buy, but still, I think that is not the case. I mean, looking at the averages here, it puts it about $63 a share on the discount free cash flow model. Free cash flow ratio of about 84, which is very, very high, which is why it doesn't like it. Ben Graham formula for intrinsic value. This looks at the PE of non-growth company, earnings per share. We look at the AAA bond yield, which is currently 5.32. That's the February number, so very high. And I think we saw the growth was at 33%, but still nowhere near. They would need to have massive, I mean, they're not growing at that rate. So this is because of the lower earnings per share relative to the price. Ben Graham does not care for the stock, but obviously we have a very high bond yield at the minute. So the final one I like to look at is the comparable company model. This is a way of valuing stocks like their competitors. We'll do quite a few here. I mean, people do compare them with NVIDIA. You know, this is GPUs and AI solutions, sort of similar in the graphics and data center. Obviously, NVIDIA, a much larger company. Another one we'll go with Intel INTC. This is more on the CPU side. And then QCOM, which is more on the processor side, wireless and things like that. So these will be quite varied, as you'll see, but it gives us kind of a, bloody Intel and their lack of profit. What about if I do, we could do TXN, Texas Instruments, more on the semiconductor side. We'll just let that load here. Once again, if you're interested in the sheet, please check out my Patreon. It's the, let me close that down, the $4 tier. This gives you full access to the sheet, and you can do your own stock reviews and things like that, stock analysis. You have full access to the data as long as you're paying Patreon. So, very, very companies. I'm going to compare against NVIDIA directly just to see, but enterprise value, NVIDIA, 2.5 trillion. All the other companies are around the same size. Revenue, AMD is third highest. Revenue growth rates, still high, 30%. Up there with NVIDIA, but way higher than Texas and TXN and QCOM. EBITDA, lowest. Profit, lowest. Profit margins, smallest margins. Look at these margins, 31, 25, and 50, whereas AMD only 6.32. So this is a very, very big difference between these and the other companies. Price to sales, it is the second lowest. Price to book, it is the lowest, which is quite good. PEG, Peter Lynch's price to earnings growth, it is the only one under a 1, which historically, according to him, is a buy. So that is interesting. EV to EBITDA, second lowest. EV to revenue, second lowest. EV to EBITDA, second highest. PE, way higher than all these, and forward P quite lower. So it does give us an average price of around about $100 a share, if comparing against all these companies directly. So still not a buy, but close to it. If we were to look at NVIDIA, just specifically, it would be a buy. You can see the average 225, 102, and 74, very all over the place, but does put it out as $134 a share. Other companies that we can look at as well, if we weren't to look at NVIDIA, for example, because obviously they're trading quite a high multiple, we'll do Avgo, which is Broadcom, once again, semiconductor and infrastructure software solutions. Let's see if this puts it $99 a share, so still not a massive buy. So yeah, overall, the models don't seem to like it. Discount free cash flow model says it is, sorry, not that one. It says it's not a buy. Ben Graham says it's not a buy, and the comparable company model says maybe a bit overvalued as well. So none of the models are in agreement, which is quite interesting. Despite, if we go back to the revenues, which I did close down, despite their growing data center revenue, which is one of their key areas, or their key revenue at the minute. Right, guys, thanks for watching. Please give a like on the video if you enjoyed. Subscribe if you're not already. Check out my Patreon, and I'll catch you guys next time.